Welcome to the Explainer. Okay, so today we're actually going to play detective a little bit. The Indian equity market going into 2026, it's a wonderfully complex and chaotic place right now, but hidden right there within all this macroeconomic turbulence might be some absolute gems. Structurally mispriced assets just waiting to be discovered. Let's see if we can cut through all the noise together and search for true value.
Okay, let's dive into this. Here is our roadmap for navigating this. First, we'll look at India's 2026 equity landscape. Next, decoding the GARP framework. Then, avoiding the stalwart trap, before unveiling 3 undervalued market gems. And finally, synthesizing the strategy. All right, kicking things off with Section 1, India's 2026 equity landscape, a bifurcated reality. Right now, as sophisticated investors, you're facing a really intense split reality in the modern Indian market. On one hand, we've got the 26% reciprocal U.S. tariffs kicking in this April 2026, and that's already triggered this massive flight of hot money. I mean, we're talking about foreign institutional investors pulling out an estimated 22,000 crore rupees in just a single week. But then concurrently, you have the union budget deploying an absolutely unprecedented 11.21 lakh crore rupees straight into infrastructure capex. So you've got this chaotic mix of indiscriminately fleeing foreign capital colliding with massive domestic government spending. And honestly, that creates an incredibly fertile hunting ground for disciplined investors who are actively looking for mispriced assets. Moving right along to Section 2, decoding the GARP framework, Peter Lynch's method. So, in a market that's aggressively pivoting away from speculative, easy money and toward quality growth, your traditional value investing playbook, it often falls a bit short. That's why our primary investigative tool for navigating this volatility is Peter Lynch's Growth at a Reasonable Price, or GARP methodology. The absolute quantitative backbone here is the PEG ratio, the price to earnings to growth ratio. Basically, a value below 1.0 flags a potential structural undervaluation. It's essentially our way of hunting for long-term compounding potential by making absolutely sure we simply aren't overpaying for that growth trajectory. Now, let's see how this builds into an actual workable system. Lynch's mechanical screening is pretty ruthless. Yes, we want that PEG ratio below 1.0, but we also demand a debt-to-equity ratio strictly below 0.2, that's for financial resilience, and a return on equity that exceeds 15%. But here's the catch. Mechanical screening is never enough on its own. You have to pair it with our 4-pillar risk analysis. That covers competition, management, regulation, and customers. Because we need to be totally sure that the undervaluation we found is actually due to true market inefficiency and not just some systemic operational value trap. Which brings us perfectly to Section 3, avoiding the stalwart trap and the danger of overpaying. Look, before we can hunt for true value, we have to identify the false leads. We have to eliminate the structurally overvalued stalwarts that are inflated by institutional crowding. Take Varun Beverages, or VBL, as our primary false lead here. Fundamentally, exceptional business. They command a massive 42.45% market share and are pushing a really robust 14.4% domestic volume growth. But then you look at the valuation reality. It's trading at an absolutely exorbitant trailing PE of up to 57.6x. That leaves us with a staggering 3.9 PEG ratio. A 3.9 PEG essentially prices in years and years of totally flawless future execution. For a new investor, that leaves absolutely zero margin of safety. And beyond just the scary math, VBL faces some severe vulnerability simply due to institutional crowding. With massive forward institutional investor ownership sitting right around 19.5%, this is a stock that has already fully enjoyed its multiple expansion phase. In our current risk-off environment, where those U.S. tariffs might sustain further capital flight, heavily owned, high-multiple stocks face totally disproportionate selling pressure. Speaking completely impartially here, when foreign institutions indiscriminately sell to rotate to safer assets, even the greatest companies are going to see their multiples violently compress. All right, now that we know exactly what a value trap looks like, Section 4, 3 undervalued market gems, finding true value. Let's pivot to unveiling 3 undiscovered gems that perfectly fit our GARP framework. Our very first gem is Godawari Power and Ispat Limited, or GPIL. They represent what we call the cyclical value archetype. Now, GPIL operates in the heavy industrials and steel sector, which, as we know, is incredibly volatile. But look at their structural moat. They have captive mines with over 35 years of iron ore reserves. That acts like a giant, powerful shock absorber against commodity price swings, basically transforming them into a highly robust, high-margin industrial converter. Because of this structural advantage, their massive forward earnings momentum actually compresses their forward PE to just 14.2x. That gives us a beautifully undervalued forward PEG of just 0.78, right alongside a practically non-existent debt-to-equity ratio of 0.06. But maintaining our objective stance here and applying our 4 pillars of risk, we absolutely must evaluate the regulatory environment. GPIL's primary vulnerability is the carbon lock-in threat. Across India, there's about 43 million tons of highly pollutive blast furnace capacity that requires relining before 2030. In an era where climate regulations are tightening globally, extending the life of those furnaces is going to require massive ongoing capex to transition to greener methods. And long-term, that is a regulatory risk that could eventually pressure their free cash flow. Let's move on to our second archetype, the fast grower. This is Jupiter Wagons Limited, or JWL. This integrated railway engineering entity has delivered a, frankly, staggering 65.82% 5-year compound annual growth rate. But what really sets them apart in this fiercely competitive oligopolistic market is their margins. JWL boasts a 14.6% EBITDA margin. How? Through a proprietary backward integration into alloy steel castings. This kind of operational efficiency actively shields them from the really aggressive race-to-the-bottom pricing strategies you see from their larger peers like Titagar and Texmaco.
And this brilliantly illustrates their absolute masterclass in customer risk mitigation. Historically, railway infrastructure firms were completely at the mercy of the Indian railways. It was a massive monopsony risk that just resulted in notoriously low-margin contracts. But look at JWL's current order book distribution. 70% of it is now allocated to private sector B2B logistics clients. They have structurally shifted away from that monopsony risk, focusing on buyers who prioritize lifecycle efficiency and specialized designs over state mandates that just look for the lowest bidder. That shift has unlocked vast new high-margin revenue streams. Okay, before I introduce our final gem, I want you to just look at this shocking number. 362. In traditional value investing, seeing a number this high would make you literally run for the hills. There's no way, right? Well, this happens to be the trailing price-to-earnings ratio for our third company, PTC Industries Limited. But as we evaluate PTCIL a bit closer, we see it is actually the ultimate optical illusion. That terrifying 362x trailing P, it's completely mathematically distorted. See, the company just deployed massive capital into a state-of-the-art facility over in Lucknow, and the resulting heavy depreciation artificially depresses their current net income. If we actually step back and account for their imminent multi-year hypergrowth trajectory as production scales up, we get a normalized forward PEG of just 0.69. That distorted trailing multiple is completely masking a profound long-term undervaluation. And the catalyst for that hypergrowth is PTCIL's totally impenetrable structural moat. They essentially function as a technological monopoly within India for ultra-precision titanium and superalloy castings. Plus, they are massive beneficiaries of India's Draft Defense Acquisition Procedure 2026, which strictly mandates intellectual property retention for domestic firms. Because PTCIL actually owns this incredibly complex IP, and because they're heavily integrated into multi-year OEM contracts with Safran for Airbus and Boeing engines, well, the prohibitive switching costs essentially transform them from a simple component vendor into a highly strategic global aerospace monopoly. Which leads us to section 5, synthesizing the strategy, bringing it all together, and seeing how our 3 subjects stack up. So, the crucial point is this. When we look across the board, notice the incredible alignment with the Peter Lynch ideals. While GPIL offers that deep cyclical value, JWL gives us exceptional capital efficiency, and PTICL brings aggressive aerospace scaling. But they all share the exact same essential survival traits. Every single one of them possesses a debt-to-equity ratio well below our 0.20 safety threshold, right alongside incredibly robust returns on equity. These fundamental strengths, especially when paired with low institutional holding, are exactly what is required to survive the 2026 macro chaos and truly compound wealth. Which brings us to our conclusion, and really a challenge for you. To succeed in this incredibly complex landscape of 2026, you absolutely cannot just read surface-level metrics. You have to understand the business on a deep level. So, are you willing to look past the optical illusions of trailing multiples to find true compounding value? I'd highly encourage you to take this GARP framework, apply those 4 pillars of risk to your own portfolio, and start hunting for your own hidden market gems. Thanks so much for joining me on this explainer, and happy analyzing.